right, what's up everybody? We'll get started here in just a moment. Let's do the quick audio check as well as visual check. So if you guys can hear me and if we are streaming in 1080p, just go ahead and give a thumbs up in the chat and we will go ahead and get started. We're gonna be walking all the way down to 20th Street tonight. I wanna show you guys the facade of a pretty cool project, a new development project here in Manhattan that's coming up here in a bit. And yeah, we'll get started in a moment. All right, I think we're good. Cool, we'll go ahead and kick this off. Well, good evening everybody and welcome back to Walks and Wall Street. Today is January 23rd, 2024. It is 8:56 p.m. Eastern Time here, reporting live. Very close to Billionaires Row. East 56th Street and Madison Avenue. Very close to the 432 Park Avenue building here in Midtown Manhattan. Now, one of the things we're going to be doing tonight is we're going to be walking all the way downtown by Gramercy, particularly Gramercy North. We're going to go all the way down to 20th Street on the corner of East 20th and 3rd Avenue. Now, the reason why I want to do that is there's a pretty interesting new project, a new development that just went up on Thursday. I'll have to look at my calendar. I think Thursday morning, I'm gonna go check it out. I'm gonna be doing a broker preview of all the units. Now, it's 200 East 20th Street. Okay, so right there on the corner of 20th and 3rd Avenue. Now, there's 52 units in the building. It spans 20 stories and it was built, or the completion date is 2024. It's a brand new building. It has over 4,000 square feet of indoor and outdoor amenities. So it's going to be a cool one to watch go up. Now, we have a couple projects that have sales on currently in Gramercy. If you want to check it out, it's 139 East 23rd Street. I'll quickly take you guys behind the screen here just to show you one of our projects. It's always good to see the competing buildings in the neighborhood. So this is our project here. Gramercy North, it's called. 139 East 23rd Street. Now, it was built in 2019. I think sales launched in 2020. And we just, thankfully, we just put unit number 2 in contract. Now, the last list price was $2,495,000. 2 bedrooms, 2 bathrooms, just over 1,500 square feet with an additional 580 square feet of outdoor space. So things are picking up, which is good. To start off the year, or to start off January, we have 2 units in contract. One at Gramercy North and one at the Conover, Unit 2B. We put that into contract. Its last list price was $1,750,000. So all good. So that's where we're gonna go today. A couple things to talk about. I'll put this link in the chat for everybody. As we know, next week is the last week of January. So January 30th through the 31st. we have the FOMC meeting when we are going to hear from Federal Reserve Chairman Jerome Powell as he sets the pace of monetary policy. So I went ahead and dropped a link in the chat. Okay, you should see www.cmegroup.com. Once again, that's www.cmegroup.com, and that's going to take you to the Fed Watch tool. So it has a countdown to the next FOMC meeting, which is in 7 days, 17 hours, and 30 seconds. And it essentially shows you a list of probabilities of the outcomes at the future Fed meetings. Now, additionally, I'll give you another link, which I think you should keep on hand and save. Now, this link is the Federal Reserve's website. Okay, if you click the link, it's going to say Federal Open Market Committee calendars, meetings, statements, and minutes. And it's going to give you the complete 2024 FOMC meeting schedule. Obviously, we kick us off for 2024 next week, January 30th through the 31st. Then we have one in March. Then we have the April-May meeting, June, July, September, November, and December. So in total, 8. There will be 8 meetings. So 8 FOMC meetings. Now, if you look at the Fed Watch tool, and we've gone over this yesterday, we'll talk a little bit about it today. The market right now is setting about a 34% likelihood or probability that the Fed funds rate is going to be around 3.25% to 3.5% by the end of 2024. We'll see. I think it's a little aggressive, being that the current Fed funds rate is in a range of 5.25% to 5.5% currently. Markets performed well today. The S&P 500 was up 14 points, closing just shy of another all-time record high. S&P is trading at 4,864. Take a look at the DJI, the Dow Jones Industrial Average, or the Dow 30. That was down about 96 points. Closed the day at 37,905. And last but not least, we'll take a look at the NDX, which is the NASDAQ 100, which is a very heavy tech index. The NASDAQ 100 closed up 73 points, just shy of another all-time record high at 17,404. All right, with that being said, we'll kick this off here, everybody. Just a quick announcement. Last Thursday, I did email everybody the Behind the Street newsletter. So our free financial newsletter that we send out every other Thursday after the market closes is in your inbox. If you have not received that yet, you can go ahead and scan the QR code on your screen and punch in your email, because we covered a lot in the latest issue of the Behind the Street newsletter. We talked about gaining a perspective on the market, right? We did a case study going back to the year 1995 onwards to the bull market of 1999. It's all about duration in terms of pullbacks. I think you guys are going to find that very interesting. We also did a deep dive into earnings season. Okay, this is earnings season, so financial earnings are here. JP Morgan Chase, Citi, Bank of America, Goldman Sachs, Morgan Stanley, Wells Fargo. We talked about some interesting and emerging trends there. And then we talked about a potential resurgence in private equity. Okay, this is kind of what it looks like. So if you want to receive that going forward, our free investing newsletter, just go ahead, scan the QR code on your screen, or type !news, NEWS, in the chat, and you can click the link to our Substack. All right, I'm going to go ahead and close up the laptop. I'll say hello to everybody in the chat, and we will get started. Thank you all for joining, and we'll see you in a minute. I'm gonna go ahead and put my hood up because I think it's gonna rain here any moment, my friends. And let's head down to the one and only 20th Street. All right, let me get the QR code out of the way for you so you can see the gorgeous New York City backdrop. And we'll get started. Lisa Davis's excellent newsletter, still learning about this area. Tom, thank you so much. Lisa Davis, I appreciate you. Todd and Tara is here. Latha, our good moderator. Patrice 2020, welcome. Dale is here as well. Good to see everybody. Lori Crockett Owens, Austin City Limits, 7-Eleven Lucas, welcome. Lena Sandoval, Silly Goose, good to see you. Thanks so much for joining us. JC is here. Welcome. R2D2, Kyle Lacey, AUS Fly Girl, Marvin, Optimus 17, The Wizard. Looks like we got a full house. Sandra Dickinson, what's up? RB says good evening, Tommy. What's up, everybody? All right, this is a good coffee shop. I'll quickly call it out here. This is Black Fox Coffee. I come here probably twice a week. My office is right over there. This is the Trump Tower right here. We're right on Madison Avenue. Couldn't ask for a better spot. Madison Avenue, 57th Street, New York City's Billionaires Row. This is the place to be. Kelly, what's up? Says hello, Tom. Good to see you, Kelly. And Two Wheel Freedom is here from Florida. I wish I was in Florida still. I just came back from Miami. Instead of going the old traditional route on 5th Avenue, it's actually bang a left here. I'll take you to Madison. And once again, we are going to be walking all the way down to 20th Street. A lot of times on the channel, in addition to our financial talk about the equity markets, we like to talk about the New York City real estate market, particularly residential and commercial real estate. Let me just make sure I have my Wi-Fi off here. We do. So there's, and Douglas Elliman, the broker that I work for, is running sales on the building. It is 200 East 20th Street. There's about 55 units total in the building. Brand new construction, really good amenities, and it's already, I think they already pre-sold 20 units. That's pretty impressive. I mean, to have a pre-sale of 20 units in a 55 unit building. Very good. So we're gonna go down there, check it out, and this Thursday morning, I will be on site doing a little bit of a broker preview. Marvin says, I love Manhattan. It's an amazing city. Yeah, I agree. It's the greatest city on earth in the world. Irina says, hello from Argentina. Welcome. Good to see all of our viewers from Argentina. You know, it's funny. When I was down in Miami, one of my favorite neighborhoods, or I should say my favorite neighborhood of all time, is North Beach, Miami. So for all of those viewers who are not familiar with Miami-Dade County, if you go to Google Maps and just type Little Buenos Aires, it'll take you to 72nd Street and Collins Avenue. And I believe it extends all the way from 72nd to about 90th Street. And it has all restaurants, bakeries, coffee shops from Argentina. It's an amazing place. It's my favorite neighborhood, and I just so happened to be down there right when Argentina won the World Cup. It was insane. I actually got a chance to take some video of that. It was awesome. I love it down there. So anyway, all right, as we head down, I want to call out this building. This is Jefferies. So this is a major financial institution investment bank right here on Madison Avenue. So if you're a real estate broker, right, it's good to have close proximity to a lot of these places, right? As we continue to head southbound, we're going to see even more buildings, JP Morgan Chase, One Vanderbilt. But I really like the architecture on the Jefferies building as well. Gary Carpenter, what's up? Latha says North Beach is nice for sure. Used to stay there back in the late 90s. Wow. If you haven't been there since the late 90s, everything looks completely different. You know, not to sort of hammer on North Beach a little bit, but I guess it does tie into the conversation about real estate. If you go all the way by the water, right, all the way by the beach, there used to be these motels and hotels that were all along the ocean front. Now, I think it was Hurricane Andrew, I forget which hurricane, that knocked a lot of them out, and they kind of just were sitting there vacant. Now, a big big investment company and developer bought all that entire strip of land, and they're totally redeveloping it. It's going to be luxury condos right on the water, and the city ripped up the entire concrete boardwalk there, and they're building something even better, which I don't even think they needed to do that, honestly. If anybody's been to North Beach recently, right, within the past year or so, the boardwalk looked fine to me, but they are going to be completely redeveloping the neighborhood. And if I had to make a prediction, I think that entire area is going to be, I mean, if you think it's expensive there now, over the next 5 years, it's going to completely change. So, Chuck Rumsford is here. What's up? Good to see you. Diana, what's up? Yeah, Marvin says it's exciting what could be happening for Argentina. For sure, there's a big political shakeup over there. This is a big year for politics. Will it impact the financial markets? Probably. But I think any sort of political change or political narrative this year, particularly in the United States, right? Because we have the presidential election year, I think that'll all be temporary, right? I think you'll have that short-term volatility around election day, maybe, you know, a week or two after, and then the markets kind of go back to normal. This is, was it Hurricane Ian? It could have been, and it probably was. I don't really remember the names of the hurricanes down there because I'm a newbie to Florida, right? So I wouldn't consider myself a full-fledged Floridian just yet. I've only been down there, like, what, 3 years now? It's kind of crazy to think that it's been 3 years, but it has. But, you know, it's interesting now that we're talking about the, you know, political spectrum here, because I was on a call the other day with a few very, very well-known investors, and they were sort of talking about a study they were looking at of historical volatility around in and around election, the day around election day, right? And a week before and a week after. And in layman's terms, and I can't give, you know, financial advice, we're just sort of talking amongst ourselves in a group, it's probably not wise if you're a long-term investor to do anything with your portfolio, right? Unless you're actively managing, you're a trader, right? And you want to take advantage of the volatility. But if you're just an average long-term investor, it's probably wise just to kind of sit on your hands 2 weeks leading up to election day and 2 weeks after, right? Because what happens a lot of the times is, let's say if you are a Republican, right? I'll just give an example. And a Democrat gets elected, and you think, oh my gosh, this is going to be the end of the world. The economy is going to tank. I'm going to sell all my stocks, right? And you flip out and you panic, right? That creates volatility. And let's say if you are a Democrat and your candidate loses and you have a Republican that becomes the president, you panic, you freak out, you think the world's going to end. And a lot of people panic and dump stocks. And one of my good friends used to be, the way he got started on Wall Street, he used to be a cold call stock jockey way back in the day, right? Working for Morgan Stanley, just picking up the phone and making cold calls to working people, you know, business owners, and trying to get them invested in whatever stock of the day that, you know, Morgan Stanley was recommending. And he would always say that around major events, election cycles, you know, any big war that, you know, broke out, or, you know, terrorist attacks, whatever, there would always be a huge influx of phone calls saying, put me to cash, bring me to cash, you know, sell everything. And he says, every time that I get that wave of phone calls, almost every time it was the exact bottom of the market, almost every time. So I think cooler heads tend to always prevail, but it's an emotional business and people get freaked out. So I think this election year, regardless of the outcome, assuming we get volatility 2 weeks leading up to the election day and 2 weeks after, if you're just an average, you know, long-term investor, in index funds and things like that, I would just sit on my hands. I wouldn't be making any major movements. Yeah, Vinny's like kind of like the movie Boiler Room. Yeah, way back in the day. Try to Travel is here. What's up? Hey, Yesterday 15. Welcome. Say Tom in chat. Yesterday 15. Welcome. We are currently behind St. Patrick's Cathedral, and we're going to be walking down to 20th Street. 200 East 20th Street to be exact, so on the corner of 3rd Avenue. It's one of the newest developments that's going up in Gramercy, and we're going to be checking it out tonight. Sally, what's up? Good to see you. Yeah, Marvin says hold and chill, right? Long Island Duck 52. Welcome. I mean, these things are always a good reminder, right? I mean, generally speaking, when your emotions are all cranked up, you probably don't make the best decisions. And this goes for anything in life, not just making an investment in a stock or even, purchasing a property or an investment. You really want to be making decisions when you're thinking straight. So when you're calm, cool, collected, and not all kind of panicked. It seems obvious, but it's not. Most people make decisions when they are in extreme stress and distress. It's kind of like a fight or flight response. Hey, John Sunderland. Good to see you. Hey, Tom. Welcome. Thanks for joining us. TV shows here. How did your meeting go today? Went good. Things are good. Things are picking up in the market. In the terms of real estate market in New York City. Last year, very, very slow. If you look at home sales, not only in New York City, but across the country, right? It was the worst year for individual home sales ever since the late 90s. So transaction volume really, really fell off a cliff. But that's something we've been talking about for quite a while, right? Optimus 17 says no business decisions should be based on hyped up emotions, for sure. And it's also easier said than done, right? Easier said than done. That's why I always say, like, if I'm at work or something and I'm, stressed out and somebody sends me an email and I should really answer it, like, right away, I just wait until I'm in a better mood or I eat something and then, think about it and then send it. You don't want to send something in haste and then blow a deal or, get somebody all riled up for nothing. Now this is 270 Park. Look at this. We are standing directly under the brand new JP Morgan Chase office tower right here. Very unique building. It's going to be a Class A office tower. The newest commercial space coming to New York City. Pretty cool. We'll cross the street so we could take another peek at it from over there. This is the M1 bus coming up Madison here. SP, what's up? Good to see you. NAB 407 says sleep on every big decision, for sure. Absolutely. And make sure if you're making a big decision that you've gotten very, very good sleep. When I was younger, it's funny, like when you're young, and I think everybody could, relate to this, you think that you know everything and you think you're invincible, but as you kind of get older, you just learn from yourself. And my cognitive performance, right, it may sound obvious, but to somebody in their early 20s or late teens, they don't really get it. But my cognitive performance declines significantly when I haven't slept at least 8 hours. And that really started to happen. I've started to notice that right around like 26, 27 years old. That like, I mean, I get brain fog, I feel sluggish and very like irritable. So I always make sure I get 8 hours of sleep. And if I'm gonna make a big decision or I have a big meeting, I gotta be well rested for sure. But a lot of people overlook that, you know, especially in this, you know, this social media culture that promotes, you know, I'm sure we've all seen those videos of, you know, oh, entrepreneurship, you gotta work a trillion hours a week and never sleep. It's actually the exact opposite of what you should probably be doing. You should be getting proper rest and prioritizing your work. You know, working for the sake of working is pointless. You should try to maximize the amount of work you do in the least amount of time. Be very calculated about your production levels. This is a pretty cool shot at 270 Park. You can kind of see the diamond insignia on the front face here. And then looking up, check that out. That is 432 Park Avenue. That's where we started the stream. That's the building on Billionaires Row. The developer is Macklow Industries, or Macklow Properties, Harry Macklow. Also did the project 1 Wall Street. Kyle says the house of diamond, quite literally. Gabriel says, do you record live every day? Most days, yes. So if you're new here, we do go live usually every day, starting at 8:30 Eastern time here in New York. We walk around the city, look at some of the notable buildings, talk about the real estate market and the financial markets. I'll try to do as best I can to get some daytime live streams in, but most of the time I'm working during the day. All right, one more shot at 270 Park. You can see the big crane boom coming off the side. Now, speaking of cranes, I gotta tell you guys a funny story, right? So, this project that I'm working on selling in Brooklyn, the address is 199 Conover Street in Red Hook, Brooklyn. I've told you guys about it many times, but maybe there's some new people who haven't heard about it. Now, one of the penthouse units, penthouse 3A, it's just under 1,700 square feet of interior space and 850 square feet of dedicated outdoor space for the penthouse. So we wanted to come up with a very interesting marketing strategy for the property. So we're like, okay, you know, let's include a sauna and a cold plunge on the roof of the property. So if you're a penthouse owner, you can go up to your roof and sit in your sauna, watch the sunrise, and have an unobstructed view of the World Trade Center, the Brooklyn Bridge, the Statue of Liberty. It's just an amazing property. You guys have to check it out. But the sauna and the cold plunge would not fit in the elevator, and we really didn't think this through. So we have to hire a crane, like an actual crane operator, to come and lift the sauna and the cold plunge on the roof. Now the sauna's already up there, the cold plunge is not, so we got to get another crane to lift it on the roof. Now here's the thing, we severely miscalculated the costs of that, because not only do you have to pay for the crane and the crane operator, right, which this is union work and these guys do great work and it's very expensive. I mean, these guys can make $170 an hour, but you also have to pay for the permits to close off the street, which is very expensive. So the building's not that tall, right? It's not like this huge mega tall building, One Vanderbilt. It's only 3 stories, but it's a little over $10,000 to get a crane, to get the permits, to pay the guy to lift the sauna and the cold plunge to the roof. Wild, right? Kind of interesting things, particularly in New York City. New York City, everything has to be done with permits. It has to be done by the book. And yeah, it's probably gonna be a little over $10,000 smacks 10 grand. Yikes. Anyway, you know, if you guys want to see a video tour of that property, this Thursday, or last Thursday, I emailed it out to everybody. It's at the very bottom of our free financial newsletter. So for those of you who are new here, every other Thursday after the market closes, so right around, you know, 4:30 to 6 o'clock at night on every other Thursday, I send it out. I publish all of my equity research for free. We cover the US equity markets, we cover emerging markets, fixed income, and at the bottom of every newsletter, we include an exclusive property tour of one of our listings here in New York City. Now, last Thursday, I filmed a penthouse tour at the Conover, so you can kind of see what I'm talking about as it relates to the sauna and the cold plunge on the roof, just by scanning the QR code on your screen, or you could type !news, NEWS in the chat, and the Nightbot will drop the link to our Substack. Hopefully next Thursday, I'm going to be including a tour of the final sponsor unit at 157, which is the first building ever constructed on New York City's Billionaires Row by Extel. And obviously Extel, the CEO and founder, Gary Burnett, just had a record sale in Central Park Tower. So the second most expensive unit in Central Park Tower just went in contract for a little over $110 million. I think it went in contract for $115 million. Wild stuff. All right, let's cross the street here. I think we're making good time. We're very close to Grand Central Station. Hey, Joseph Hardaway, what's up? Thanks for joining us. TK Porsche, speaking of permits, what is the latest on the partial building collapse in Little Italy? I'm not too sure. I saw that. I haven't really been following it. Essentially, you know, it looked like the entire facade of the building just like fell over, which is crazy. And you could actually see into people's apartments, which is wild. I mean, there's been a lot of infrastructure problems in the city, not just that building in Little Italy. I think there was also a parking garage that collapsed too, if I'm not mistaken. It's wild. It's crazy. I mean, the problem is a lot of these building owners and landlords, they don't have the money to make the necessary repairs. It's just so expensive. Joseph Hardaway, this is Happy Tuesday. Thank you so much. Appreciate it. Happy Tuesday to you too. Wow, Leila, does it cost about $2,000 to $3,000 for a crane in Hoboken in 1992? Yeah, so with inflation, I think 10 grand sounds about right. Just to guys, this time I had to hire a crane. Hold on, let me scroll up to that. To get my boat out of the water, and it was per minute. Ah, got it. How much did that cost you? So if they charge you by the minute, I mean, I guess in theory the guy could, you know, sit in the crane, watch a couple movies. No, I'm just kidding. You never know. All right, this is Madison Avenue and East 42nd Street. We're going to see a good view here of the Chrysler Building. And this is looking towards Salesforce Tower in the distance there. It's a pretty cool shot of One Vanderbilt and the moon. All right, we got the light. Let's continue down. So we'll quickly just cover the equity market for those of you who just joined. The S&P 500 and the NASDAQ 100 were both up today, closing just shy of yet again another all-time record high. Now in 2023, both the NASDAQ, I should say the NASDAQ Composite and the Dow Jones Industrial Average hit new all-time record highs, but the S&P did not. The S&P took all the way to 2024 to hit an all-time record high, but still the laggard, like we've been talking about, is the Russell 2000. The Russell is still in a bear market, but here's kind of my thoughts on that as we're looking at this stunning view of the Chrysler Building. I mean, that's about as good a shot as you're ever going to get of it right there. Really stunning. Now, assuming, right, that the futures market is correct, if you look at the CME Group watch tool, the Fed watch tool that we were talking about, it is pricing in a rate cut at every single FOMC meeting this year, except the one that we're going to have next week, the January 30th to the 31st meeting. So in theory, you know, if interest rates come down, that's going to positively, I should say, positively impact a lot of these smaller cap Russell 2000 companies. Because, generally speaking, the quality of companies in the Russell 2000 are not of, I should say, as high quality as, you know, some of the larger cap S&P 500 companies. And they also carry a significant amount of floating rate debt. So if a company is carrying floating rate debt, as interest rates go up, well, guess what? It's going to be more expensive for those type of companies to service their debts. So more money that comes in, right, through revenues is going to be allocated towards debt servicing, right? Also, as interest rates go up, it discourages companies from borrowing money, so new debt acquisition to grow their businesses, to build new warehouses, to invest in, you know, research and development, to hire new employees and things like that. So it could potentially be, you know, could the gap close between the S&P and the Russell, assuming that rates come down next year, or I should say this year. We'll see. I have my doubts that there's going to be that many rate cuts next year, or this year, I should say. I don't know, what do you guys think? I mean, just to quickly review as we're looking at Grand Central Terminal here. Beautiful building. The current Fed funds rate is at 5.25% to 5.5%. Do we think we are going to end the year 2024, December, with 4% Fed funds rate? Do we think that is doable? Do we think it's possible, or no cigar on that? This is a good view of the MetLife building and One Vanderbilt. We'll cross the street just so we can look at the construction site of, I think they're going to be taking down this Grand Hyatt. You can see everybody getting in their taxi cabs. Mr. Bagman, what's up? Says Netflix added 13 million new subscribers. Company continues to crush it. Yeah, and you know what's interesting about that, Mr. Bagman? Way back, since we're at Pershing Square here, Bill Ackman and Pershing Square made a sizable investment in Reed Hastings' company. Then they bombed on earnings and they blew out the entire position. So even though, fast forward a year and a half, the stock moved in the complete opposite direction, the stock actually went up, it was the right thing to do from a risk management perspective to kind of blow out that position. But yeah, I've always been kind of skeptical now of a lot of those streaming platforms and services, because how much can the market absorb? I mean, what are your thoughts on that? And what I mean is, it seems like every company has a streaming subscription service now. You have Peacock, you have, HBO Max, Netflix, Hulu. So how many streaming services realistically can consumers tolerate? I don't know. According to a Wall Street Journal article, they said that the average American household, so this is a family of 4 or 5, has on average 3 to 4 streaming subscription services. Now, does that sound correct to any of you who is watching the stream? I guess it'd be a better question to say, out of everybody who's watching, if we could just put in the chat, how many streaming services like Netflix, Hulu, YouTube Premium, how many do you subscribe to in total? Would you say more than 3 or less than 3? Oh, look at this shot of the Chrysler Building and the moon here. That is an incredible shot. I know Mark Francis 076 says there's too many streaming services, and I think there's about to be even more too. Oh, you have Disney Plus, that's right. Disney Plus is another one. Optimus 17 says, yes, I have 3. Jerry says, I have 3. Junior says, I have 4. Mary says, I have 1. Billy says, you have 0. Okay. Leda says 0. Greg says 3. Harry Walker says 2. And John says 1. Noah says 2. More than 3. So it seems like the majority of people have like 2 or 3 in the chat. So it looks like the Wall Street Journal article was correct. Interesting. Mario says, I'm subscribing to 0 streaming services. John Francis says, I only subscribe to Paramount Plus. Copy that. Yeah, with any of those SaaS businesses, it's just important to calculate your churn ratio, right? So if you're paying, $15-20 a month, for a subscription service, what Wall Street wants to know is, what is your retention? Or how are you retaining those customers, right? I think I saw an interesting comment about this Grand Hyatt. So let me scroll back up. Royce Reed NM. This is Tom, the Grand Hyatt site replacement is controversial because it would be massive and block the views of the Chrysler Building. Oh my God, that's horrible. And you know what happened? Which you guys are going to be able to see this tonight. I agree with the controversy of blocking the views of, some of these amazing buildings, like the Empire State Building and the Chrysler. Because listen to this. As you walk down towards Gramercy, particularly if you're standing directly outside of the very famous Flatiron Building, right? So right across the street from Madison Square Park. That used to be, by far, the most amazing and iconic view of the Empire State Building you'd ever get. Now, a little bit closer to Koreatown, I think it's on 30th Street, there's this massive new, luxury condominium that's built. So as you stand right outside of the Flatiron Building, you can't even see the spire of the Empire State Building anymore. It's totally obstructed by this new development. So I can imagine as this building comes down, it could, I think you're right, yeah, it could potentially from afar block the Chrysler Building in and of itself. And it looks like it may block a little bit of One Vanderbilt too. I don't know. Scott Wheeler says YouTube has more interesting streaming and it's also free. I think to some extent, right? To some extent it's free, but I also think YouTube Premium has, I think it's like, what, 15 bucks a month for YouTube Premium or something? S-Piece is the Flatiron Building. Yeah, that's another big project. So the Flatiron Building was acquired right at auction, right? It sold at auction, and it's going to be converted into condominiums, which I don't know. How do you think that's gonna work? Because obviously, if you've seen the Flatiron Building, if you Google a picture of it, it's very narrow. So I don't know how the floor plans are going to. I don't know how it's going to turn out. But then again, you know, these architects and developers are the best in the business, so I'm sure they're going to figure it out. But I'm just trying to picture myself living inside the Flatiron Building with those very narrow floor plans. We'll see. Yeah. But if you guys are enjoying the live stream so far tonight, feel free to leave a like on the video and click the subscribe button if you're new. We do these live streams every night starting at 8:30. Hey, NYC Home says, hey Tom, I'm currently in high school and looking to pursue investment banking or a unicorn/FANG after college. Not that it's my top priority, but which career path generally lives a more lavish New York City lifestyle? Well, I would definitely say that it depends on what you want to do at a FANG, right? Do you want to be a software engineer? Do you want to be a PM like at Meta or something? Like what do you want to do in big tech, right? Do you want to be in tech sales, right? Which is also a very, very lucrative career. If you could sell software or telecom, those are also very lucrative careers. I'll say this, investment banking is going to be much more structure, okay? It's going to be much more structure for you, and I think you really need to love the business. I really think if you're going to go the investment banking route, you really, really, really need to love the business and do it. And it's a very lucrative career path, but the hours are going to be very aggressive, particularly early on, which is fine. And you do need to be in the office almost every day, including Sundays, particularly if you get a job at, you know, let's say like a bulge bracket investment bank, like a Goldman Sachs. But your career trajectory is very lucrative, particularly as you get up towards, you know, managing director. You know, a managing director on Wall Street, you know, not uncommon at all. You know, you're going to be making over $1 million a year. That's not uncommon at all. If you want to be, I would say the more lucrative opportunities in finance would probably be going to work as a quantitative researcher at like a Citadel, a Two Sigma, what else? Like a Jump Trading. So I think if you're very skilled in computer science, I would explore an opportunity to work as a quantitative researcher at a major quant hedge fund, like a D.E. Shaw, right? David E. Shaw and Co. That's actually where Jeff Bezos got his first job out of college. He worked for D.E. Shaw, which is a quantitative hedge fund right here in New York City. I think tech, working in tech as a software engineer, generally speaking, and if you're in sales, the work-life balance is a lot better and you can be a little bit more creative. You know, investment banking is very buttoned up, and I don't think you could be as creative as if you are, you know, a software engineer at a big tech company and then maybe you work at a startup or something like that, right? So it just depends on really what you want to do. But both of those career paths are extremely lucrative. And also, you know, not to sort of go on a tangent here, but also you could think about your exit opportunities. If you spend, 2 or 3 years at the investment bank, right? If you're an IB, there's also many different departments at the investment bank. You have very good exit opportunities. So you can go into private equity, you can go into the hedge fund business, you can go into VC, right? Venture capital. Maybe you're interested in that. If you're interested in investing in early stage startup companies, right? You have extremely good exit opportunities into private equity and venture capital if you go the investment banking route. I don't know, anybody else in the chat? We have a lot of people here who work in tech or in banking or have had careers on Wall Street. Would you agree with that, disagree? I spent about a decade in tech sales. It was very lucrative, but it wasn't rigid and structured like investment banking. It's sort of like an eat what you kill environment. If you hit your quota and you are crushing it, the boss kind of leaves you alone, but you really need to be a self-starter. If you need to have your hand held and have your boss tell you what to do, I don't think sales is the right path. Hey DC, what's up? Welcome. 456 says for quant, you need to be math or physics PhD. You don't need a PhD. But many of the top, quantitative funds out there, you're right, they do hire, very talented people, with very advanced degrees. But it's not a requirement, but it's easier to do. Kyle says, if you don't truly love doing investment banking, no amount of money would be worth the grind for you. Well, everybody has a price. That's what I believe. Everybody has a price. And I think very early on, and maybe a lot of people would disagree with this, but if you're in your early 20s, just graduating college, I would not pursue what you absolutely want to do. That's just my opinion. It doesn't mean I'm right. But when you're, 20, 21, 22, even all the way up to like 28 years old, it's not always the appropriate choice just to pursue really what you love. Because you could love, walking dogs. You could love making, cups of coffee, but that's not going to pay the bills. So when you're right out of college, right, and if you're smart and you're capable and you could do the grind of investment banking for 5 years, live like a hermit, bank your entire salary. Yeah, it's going to be grueling, and then go pursue your passions, because you have hundreds of thousands of dollars liquid in the bank, sometimes millions of dollars if you're in the right spot. So, I think very early on in your career, be willing to do things you don't want to do. We all have to do things we don't want to do, right? So wake up early, go into the office, right? Slave away at your desk when you're 21 to 28 years old, and be very fiscally responsible, and if you're knocking down $350,000 to $500,000 a year in your 20s, bank it all, and then say, you know what, this isn't really what I want to do long term. Now I'm going to use this capital to deploy into my passions, to try to start that business I always wanted to start, or something like that, right? So I would say it is definitely worth it, right, for the network you build, but it is going to be grueling. But I think at the end of the day, we all need to do things we don't want to do, at least sometimes, in my view. NBA Elias says 80% of the graduate college courses I took are useless for my current job. Got it. I think I feel the same. I think a lot of people could say the same. Yeah, I think I'd agree for me. Matthew, good to see you. This is my friend out. My friend went out every week to network with people around Bryant Park by buying them coffee and chatting before becoming an IB. I think that's a really good idea. Yeah, I mean, investment banking is all about relationships, right? Really everything is, right? If you want to, do really well when you're really young, just get around the right people. You know, when I was just starting out, when I had my first account executive job, like sales job, that's a more fancy buttoned up term for your sales guy or girl. What works for me really well is look at the leaderboard at your company. Let's say if you work at Salesforce, Microsoft, T-Mobile, right? Whatever you're selling. Look at the leaderboard and you're gonna notice a similar pattern. It's gonna be very clear. There's gonna be 5 people that's gonna be at the top of that list every month, every quarter. So if you work in tech sales or in sales in general, your company's probably gonna send out, you know, at the end of every month and every quarter, like a leaderboard list. And it's gonna be, oh, congratulations to the top 5. And very seldom do the top 5 change. Very, very rare, right? It's kind of like the Pareto principle. You know, 20% of the people drive 80% of the results. So if you're young, you print out that list and those are your 5 targets. And you want to get as close as possible to those people. You want to build as good a relationship as you can and, you know, make a value proposition. Say, hey, I'm just graduating college. You're at the top of the list. I want to be where you are someday. I'll make calls for you. I'll send emails for you. You know, I'll set appointments for you. Anything that I can do to help you drive more business, let's work together. And people will be very receptive to that. That's how I got started. You know, the most of my deals that I closed in my first 3 years, I had the top performers in the office helping me on those deals, but I gave away half the commissions. But would you rather have 0, or would you rather be doing deals and crushing it like crazy and giving away 50% of your stuff? And then as you build a big book of business and learn the ropes and learn how to do things properly, then you go out on your own and you can become self-sufficient. But you gotta get around the winners in the office, okay? Particularly if you're in sales, because chances are, you know, it's a very eat what you kill environment. So there's gonna be a lot of people who aren't performing well in the sales organization. And those people are gonna complain about the job. They're gonna talk bad about the boss. They're gonna say, oh, this company's screwing us over. We're not making any money. And you gotta get away from those people as fast as possible and disassociate with them, or they're just gonna bring you down. You gotta get around the winners. All right. Wow, look at this. Amazing shot of the Empire State Building. Man, that is gorgeous. I wonder why it's lit up in this color. It kind of looks like the New York Mets, doesn't it? The color scheme on the Empire State Building. It's like the New York Mets a little bit. If we walk a little bit further, we'll get a better view. Let's see. Yeah, this is it. Check this out. Pretty cool, right? Oh, it's the Knicks colors, says Optima. Very cool. Hey, Evan Weeks is here. What's up? Good to see you, Evan. Thanks so much for joining us. Appreciate you. NYC Homes is Tom. I probably want to start out as a software engineer. Very cool. For tech and then advance to a PM or something. Yeah, I mean, NYC Home, if you want to send me an email, I'll help you. I'll help you out. All right, where are we going here? Oh yeah, so we are going, just to quickly remind everybody, for those of you who are just joining, we're gonna take a little bit of an expedition. Word of the day, expedition. To 20th Street, East 20th Street to be exact, 200 East 20th Street. It's a brand new residential development in New York City. Douglas Elliman is leading sales on that. And on Thursday, I'm gonna be checking it out. I'm gonna be doing a little bit of a preview. Now there's 55, I believe, units in the building, and they're already pre-sold about 20 units, which is very impressive. So we'll check out the facade tonight But if you guys are enjoying the live stream, feel free to leave a like on the video and click the subscribe button if you're new. And if you are interested in these conversations that we have each night about the financial markets, about careers in tech, in real estate, in finance, we do write a bi-weekly investing newsletter called Behind the Street. So every other Thursday, we send out all of our equity research for free. We talk about the US equity markets, emerging markets, fixed income, and the New York City real estate market. If you scan the QR code on your screen and punch in your email, you will be signed up to receive it. That is our Substack, or you could type !news, NEWS, in the chat, and the Nightbot will drop the link to the Substack. We talked about a lot in the latest issue. I don't think you guys are going to want to miss that, so go ahead and check that out. Just wait for this car to cross here, and we'll continue to head down Fifth Avenue. Hey, Ryan Beck, what's up? Good to see you, sir, all the way from Texas. Welcome to a very freezing New York City. It's about to rain any moment here. Hey, Kyle says commercial/corporate banking is a great place to be. I agree. No, MBA Elias, let me see. It says, have I read Atlas Shrugged? Great speech towards the end. Oh no, Marvin said that. I have not. I will check it out. Feel free to put the link in the chat. I think we'd all love to benefit from that. Hey, Ed Podke, what's up? Good to see you. Thanks for joining us. Let me see if I can catch up on some of the comments here. Matt G says, hey Tom, any insights into data analytics careers and courses that may help lead into that? Yeah, if you send me an email, thomas.malloy@element.com, there's a ton of free resources out there, and I could send you some. And there's a lot of good courses too that are also free. Now there are some paid ones, which I think are worth it. They're like $500 courses, but they're very good. They're very, very good. And that's the beauty of, if you want to work in tech, particularly if you want to be an engineer, right? Software engineer, to some extent, right? Because if you're an autodidact and you could self-teach yourself, a lot of this stuff, you can get, lucrative opportunities, right? Even if you do boot camps, things like that, you can get a job, maybe not at, the top tier FANG names, but you can get a job at a tech company, a startup, making a very good salary by just, learning how to code in some of these very common languages. Okay, this is the building right here that's blocking the view of the Empire State Building from downtown. We'll see it a little bit better a little later. This is the Empire State Building. Evan Weeks is software engineer for SWE. Is an oversaturated field at the entry, an intermediate level right now. Opportunities are bare on the ground and not paying what you imagine they might. Evan Weeks says, even at my level, the overemployment and contract opportunities I had 2 years ago have dried up. Now, yeah, that's also true. There's been a lot of layoffs in the industry, particularly at the turn of 2000. I should say the turn of 2021 into 2022, when you had that massive fallout in the market. Because a lot of these tech companies, to your point, especially a lot of these startups, unicorns, things like that, it was really all subsidized by very cheap money, right? Cheap debt. And in the SaaS business, software as a service, it's really been just grow top line revenue at all costs and not really focus on profitability. So a lot of these companies, could survive in an environment of ZIRP, right? Zero interest rate policy, because they could take out money, or essentially buy money in perpetuity at very, very inexpensive rates. But when the market turned, right, because the Fed started to raise rates, a lot of those tech companies went down like 90%, right? And then you had massive amounts of layoffs. So you're right. You're right. All right, we're coming up on Koreatown now. Yeah, MBA Elias, Bill Ackman videos on investing in cash flows is a great place to start learning about finance. I agree wholeheartedly. Those are great videos. There's also a free course that you could take right now at the NYU Stern School of Business by Professor DeMotoran. They call him the Dean of Valuation. Now, he teaches two courses that are very popular. One on corporate finance and one security, let's just cross the street for a second, analysis. Now, he's a very nice guy, very generous guy, so he publishes all of his lectures for free for anybody to download and listen to and watch. He even publishes the exams. So the final exam that the MBA students take for corporate finance and securities analysis, you could do for free. I've included a link to that course in the latest newsletter. So if you just type !news in the chat and you click the link where it says Walks Wall Street /Substack and you scroll down, the course link is there. So again, you're not going to get like college credit for it, but if you want to learn the material, right, that's what education is all about. Education is really all about learning the material. I think a lot of people have sort of gotten away from that and they just want chasing the piece of paper, right? And they sort of overlook the reason why they get the piece of paper. You get the piece of paper because you can acquire and accumulate that knowledge. So you should definitely take it if you're interested in finance. It's free and you'll learn a lot. He's one of the best professors for finance in the world. He's right here in New York City at NYU. So this is it, guys. This is the building. Now, as we head closer to Madison Square Park, you're gonna get a better idea of what I'm talking about. So the building is so big, it looks like it's on 29th Street, that it will totally block out the view of the Empire State Building. So let's continue to walk down to 23rd Street. That's going to take us right outside the Flatiron Building. And you'll get a sort of an idea of what we're talking about here. We just passed Koreatown, by the way. Very cool. Someone says my bachelor's is in product design. I think late 2024, maybe the start of 2025 will be amazing for tech. Just some patience. I agree. I generally agree. Now, if you look at the market, right, the stock market, a lot of the more established tech companies are doing really well and trading at new all-time record highs. But if you look at a lot of the startups, right, or the companies that are just in their early innings of their growth phase, a lot of them haven't really made it back to their record highs yet. And those are a lot of the companies that are doing a lot of the trimming. Now, to Evan Weeks' point, Evan Weeks made a great point. And it reminds me of something that the CEO of Meta, what Mark Zuckerberg said last year. And he said 2023 is going to be the year of efficiency at Meta, right? Because during the ages of ZERP and cheap money, Meta grew their headcount enormously, right? With these massive six-figure salaries, equity packages, and just, things were a little bit euphoric. And when the saying is, it's all funny when you're making money, right? You kind of get drunk at the punch bowl. And then when hard times come, you kind of got to hunker down, get back to the basis, and let some heads roll, And that's exactly what Mark Zuckerberg did. He slashed and slaughtered over 30% of his workforce, got very lean, very mean, and now Meta is back at a new all-time record high. So revenue stayed consistent and actually exploded. Profitability exploded, and their overhead cost on employees cratered, right? Look at this building, Smile Direct Club. Very cool loft style here. Hey Marvin, thank you so much for joining us. We will see you tomorrow. Appreciate it. Daryl from Chicago, Illinois is here. What's up, Daryl? Almost there. A couple more blocks. Looks like they're doing some major construction on the sidewalk. Evan Weeks says we haven't the first clue. How AI will affect things. Yeah, that's true. We suspect some of it, but the full extent is going to be insane. I agree. And I think we're in the very early innings. I think you can make a good point. Now, that's why I'm also very bullish long-term on the US stock market. Right? And maybe I'm wrong. I could be wrong. I don't know everything. I'm just guessing like everybody else on Wall Street. But I mean, think about it like this, right? And I won't give you the answer. I'll let you guys do some homework, and I'll let you read between the lines. I want you to do some research on what the average profit margin is, or average gross margins across the S&P 500. Okay? So get that number. What is the average gross margins across companies in the S&P? Okay, once you have that, here's step two. All of these articles, okay, all of these research reports, all these talking heads on TV, the analysts, the pundits, the researchers, the professors at the top schools, they claim, okay, now they could be wrong, but they claim that profit margins. AI could expand profit margins at the average company by 8% by the year 2035. Now, to the average person, 8% doesn't really sound like much, right? 8%, 8%. Guys, if the average company in the S&P could expand gross margins by 8% across the board because of AI, right? So they're streamlining their processes, you know, they're cutting specific departments like compliance, audit, all this stuff. And if that explodes gross margins across the board by 8%, I mean, this market is gonna rock, okay, over the next decade. Now, that may not happen. I don't know. I'm not an engineer, but it seems like it possibly could. I mean, if you've watched any of these interviews with, you know, Elon Musk, Bezos, even the CEO of Citadel Securities, Ken Griffin, he's saying like this technology could significantly revolutionize the way we work and expand gross margins. An example of that, just a regular example, let's say if you're a QSR restaurant, right, quick service restaurant company, like a McDonald's, like a Wingstop or something like that. All of these, you know, kiosks, these ordering kiosks, right? Those are going to be replacing employees. What happens when that sort of machine learning, that AI, those robotics come and replace the assembly line workers for the food prep? And it's happening. There's I think if you type !suite, SWEET, in the chat, it's going to drop a link to Sweet Green's Ghost Kitchen, I think they call them. And there's no employees, and the machines make all of the prepared food in the exact portions. I mean, think about how much slippage there is, or how much shrink there is at Chipotle, at Sweet Green, because, you know, the guy behind the counter is really cool and he gives you, you know, 2 scoops of chicken and he only charges you for 1. A robot's not going to do that. A robot is going to give you the exact measurement, and they're going to charge you the exact price. That could explode profitability at some of these companies. So, right, we could debate on if it's positive for humanity, right, all day, but we'll see. Okay, more importantly than AI, guys, this used to be the most beautiful view of the Empire State Building, standing directly outside the Flatiron Building. But look at this. You now have this monstrosity of a luxury apartment building that totally overshadows the view of the Empire State Building. Look at that. Crazy, right? Hey, James Tiger says, if you have no employees, how do people have money to buy anything? Well, the way I kind of think about it is the following. All right, let's cross over. Yeah, Evan Weeks is correct. Yeah, robotics is kind of a different topic. AI, machine learning, is all about big data, crunching and turning it into impenetrable amounts of data into digestible, actionable business intel. Yes. So like AI, machine learning, and robotics, all that lumped into one, right? That mega trend that we're having. But yes, you're correct. Like the robotics, oops. Well, I think we're gonna have to cut the stream short because the gimbal died. Well, let's see if we can get it working again. I'll make a quick comment on the AI sort of taking jobs. You know, in every single, how should I say this? every single major technological revolution, it's crushed and killed jobs, but it's also created jobs that we don't even think about, right? Or haven't really even thought about. So, I mean, in the year 1995, right? If somebody came up to you from the future and said, hey, I'm from the future, and, you know, my job is a social media marketing manager, you'd be like, what? What the heck is that? And they're like, yeah, I run social media for some of the biggest companies in the world. Or they say, yeah, I'm a Salesforce administrator at, you know, Morgan Stanley. You're gonna be like, you're a sales what? What is a Salesforce administrator, right? So software and technology creates so many different jobs. You know what I mean? So I think that's probably what's gonna happen in this circumstance. But, you know, I think we will call it a night here. We'll have to check out and look at that building another night. I have to charge my gimbal. But if you guys enjoyed the live stream tonight, feel free to leave a like on the video and click the subscribe button if you're new. We do these live streams every night starting at 8:30 p.m. And if you enjoy the topics of conversation about the financial markets, tech, and the like, we do write a free financial newsletter and email it to everybody every other Thursday after the market closes. You can go ahead and scan the QR code on your screen and punch in your email, and you'll be signed up to receive our newsletter every other Thursday covering the financial markets, tech, and real estate. But until tomorrow, we'll see you guys, and have a great Wednesday. So Mark Francis, appreciate it. Brad's Brain, thank you for joining us. Evan Weeks, appreciate it. Sharon, all of our good moderators. Guys, take care, be well. Always a bull market somewhere. You just need to know where to look. Take care.